What Darvas realized next is what separates survival from extinction. The market is not chaotic noise. It is structured hesitation followed by violent decision. Price pauses before it moves. Not always, but often enough to build a rule around. The amateur sees that pause and feels uneasy. No movement feels like failure. The professional sees the same pause and feels relief. No movement means no risk expansion. Darvas stopped asking where price might go. He started asking whether price had proven anything yet. That single shift rewired his psychology. He noticed that after a strong advance, winning stocks stopped trending. They didn't collapse. They rested. Buyers and sellers reached a temporary agreement. Volume dried up. The tape slowed. Price bounced between two obvious levels again and again. That range wasn't random. It was negotiation. Institutions were accumulating without moving price. Amateurs got bored and left. Darvas stayed. He drew a simple rectangle around that range. Nothing fancy. No indicators. Just the highest high and lowest low that price respected. That rectangle became a decision boundary. This solved a major psychological problem. Before, every tick felt important. Now, most ticks were irrelevant. Inside the box, he did nothing. No predictions. No opinions. Waiting became an active position. That alone eliminated dozens of emotional mistakes. Fear had less to react to. Greed had no signal to hijack. Discipline replaced impulse. The rule was brutally simple. He would only act if price proved itself. Not whispered. Proved. A clean break above the box was confirmation. That breakout was the pivotal point. Anything before it was guessing. Anything after it was execution. This wasn't about being early. It was about being right with risk defined. Darvas accepted that he would never buy the bottom. Professionals don't need perfect entries. They need survivable ones. Risk was calculated before emotion entered the room. Position size came from the stop-loss, not from confidence. If the distance to the stop was wide, size was small. If the distance was tight, size could be slightly larger. Either way, the dollar risk stayed constant. Usually 1 or 2%. That made losses tolerable. Tolerable losses keep traders rational. Rational traders stay alive. Darvas also learned something subtle about identity. Amateurs want to be right. Professionals want to be consistent. Consistency comes from rules you obey when you feel stupid, bored, or scared. The box gave him that structure. It told him when not to trade, which is where most money is saved. Every box filtered noise. Every breakout earned attention. He wasn't chasing the market anymore. He was letting it come to him. There was still discomfort. Waiting always feels wrong at first. Your brain associates activity with progress. Darvas had to override that instinct daily. He reminded himself that capital unused is not capital wasted. Capital lost is. This mindset turned patience into an edge. While others burned energy reacting, he conserved it waiting. This leads to the real inflection point. Once you accept waiting as a position, the next challenge appears. What do you do after the breakout works? Most traders either take profits too early or increase risk too fast. Darvas faced that temptation next. And how he handled it is what transformed isolated wins into a compounding process. The box did more than define entries. It rewired Darvas's sense of control. Before, he felt chased by price. Every tick demanded a response. Inside the box, that pressure disappeared. Price could move all day and nothing changed. The rules were already written. That calm is not accidental. It comes from predeciding behavior before fear/greed shows up. Darvas noticed another detail most traders miss. The longer a box held, the more meaningful it became. Time added weight. Weak hands exited. Strong hands stayed. Volume contracted. The tape grew quiet. This silence was information. It told him sellers were no longer aggressive. That's why he never rushed. Rushing destroyed the data. Amateurs hate this phase. They feel left behind. They enter early to feel involved. That involvement feels productive, but it's false progress. Darvas learned that involvement without confirmation is just disguised gambling. The box wasn't a setup to trade inside. It was a filter to keep him out. When price finally pushed above the box, Darvas didn't celebrate. He executed. No emotion. No relief. Execution only. His buy stop removed hesitation. Either the market accepted higher prices or it didn't. If it failed, the stop loss handled the exit automatically. That automation protected discipline when adrenaline spiked. This is where risk control quietly does the heavy lifting. Because position size was small, the outcome didn't matter psychologically. A losing breakout didn't hurt identity. It was expected. Darvas assumed many breakouts would fail. That assumption made him flexible. Flexibility is impossible when risk is oversized. He also ignored everything except price. No forecasts. No macro opinions. No stories. The tape was the judge. If price held above the box, the market agreed with him. If it fell back inside, the market disagreed. He didn't argue. He stepped aside. This created a powerful contrast. Amateurs searched for certainty before entry. Professionals accepted uncertainty and defined risk instead. The box made uncertainty manageable. It turned chaos into a yes or no question. Above the box or not. Nothing else mattered. There's a paradox here. Waiting felt passive, but it was aggressive discipline. By not trading, Darvas avoided low-quality situations. Those avoided losses compounded just as much as winners. Survival improved before profits did. That order matters. Another subtle shift happened. Darvas stopped checking prices constantly. There was nothing to react to inside the box. This reduced emotional fatigue. Fatigue leads to mistakes. Rested attention leads to patience. Patience leads to better decisions. Darvas also tracked how often he was wrong. The number surprised him. More than half his breakouts failed. That fact didn't discourage him. It liberated him. He realized success was not about accuracy but asymmetry. Losses were capped. Gains were open. One strong trend paid for many small failures. This statistical thinking separated emotion from outcome. Each trade became one of 100, not a verdict on self-worth. Amateurs personalize losses. Professionals depersonalize them through numbers. Darvas wrote everything down. Entry, exit, risk, result. This journaling exposed patterns he couldn't feel in real time. Feelings lie. Records don't. Over time, the box method proved itself not in single trades, but in sequences. Consistency emerged slowly, then suddenly. That realization removed urgency and replaced it with calm repetition executed without drama. Day after day, rule after rule, the edge compounded invisibly while others chased noise and excitement. Still, a new temptation appeared. When a breakout worked, confidence surged. The urge to press harder appeared immediately. Many traders blow up right here. They confuse confirmation with invincibility. Darvas recognized that danger early. He knew the first breakout was only proof of interest, not proof of permanence. So he asked a different question. How do you press winners without increasing risk? How do you let the market pay you without giving emotions control? The answer wasn't adding randomly. It was structured pyramiding, governed by the same box logic. That next layer completed the method. Pyramiding forced Darvas to confront his own psychology more than any entry rule ever did. Adding to a winning trade feels logical, but it triggers the most dangerous emotion in markets: entitlement. After a win, amateurs feel owed more. Professionals feel exposed. Darvas learned to respect that feeling instead of feeding it. His mistake came from confusing momentum with permission. The stock surged, headlines followed, and confidence spiked. He interpreted strength as safety. That assumption was wrong. Strength without structure is just volatility wearing a mask. When the pullback came, it wasn't violent, but his oversized position turned a normal retracement into emotional chaos. He exited early, not because price broke rules, but because fear arrived first. That experience reshaped his process. From that point forward, pyramiding was never a reaction. It was pre-planned. If price broke out and then built another box above the first, that box became new confirmation. Only then could exposure increase. Not double. Not aggressively. A smaller unit, always smaller than the first. This kept total risk flat even as market exposure expanded. The protocol mattered less than the mindset behind it. Darvas accepted that the first entry was always a test. The second entry was earned. The third was rare. Most trades never reached that stage, and that was fine. He wasn't searching for constant additions. He was searching for exceptional alignment. This filtered ego out of the equation. Stops moved with structure, not emotion. When a new box formed higher, the stop for the original position moved up beneath the previous box. This locked in gains without choking the trade. The market decided how far the move could go. Darvas simply stayed attached as long as price allowed it. He never widened stops. He never hoped. Hope was not a strategy. Amateurs struggle here because pyramiding exposes intention. Adding reveals whether you respect risk or worship profit. Darvas respected risk first. Profit followed naturally. Fear/greed lost leverage because decisions were already made. There was nothing to debate in the moment. Another subtle benefit appeared. Losing trades ended quickly. Winning trades demanded patience. That reversed the natural tendency of the human mind. Most people hold losers and cut winners. Darvas engineered the opposite through structure. Structure beat instinct. He also eliminated outside influence during active trades. Tips felt intoxicating when already in profit. He refused them. Opinions distort tape reading. The tape didn't care about his position. Price was either holding structure or violating it. Nothing else mattered. This discipline created emotional neutrality. Wins didn't excite him. Losses didn't depress him. Both were expected outcomes of a probability game. That neutrality is rare. It comes only when risk is fully accepted in advance. If you fear a loss, your position size is wrong. Darvas lived by that rule. Still, one final weakness threatened everything. Even with boxes and pyramiding, a trader can bleed slowly by refusing to admit invalidation. Darvas saw others ride collapsing trades into disaster. He knew survival depended on speed, not intelligence. The faster you admit you're wrong, the longer you stay in the game. That realization led to his most unforgiving rule. The rule that ended arguments with the market instantly. The rule that transformed losses from emotional wounds into mechanical exits. It was simple, painful, and absolute. And it made everything else work. It demanded obedience without negotiation. Once price crossed the stop-loss, the trade no longer existed. No rationalization. No second chances. This final discipline closed the system. Boxes defined opportunity. Pyramiding expanded winners. Stops preserved capital. Together they formed a mindset built for survival first, profit second, and longevity above ego-driven brilliance. This obedience felt harsh at first, but it removed hesitation entirely. When hesitation disappears, execution becomes clean. Clean execution reduces stress. Reduced stress restores patience. And patience, more than intelligence or prediction, is what allowed Darvas to stay solvent long enough to let probability. Respecting the stop-loss required Darvas to dismantle his ego piece by piece. At first, stops felt like admissions of failure. Each exit felt like proof he was wrong. That mindset was poison. The market doesn't grade you on correctness. It grades you on survival. Darvas learned that refusing to exit was not strength. It was attachment. One early trade defined this lesson permanently. Price dipped slightly below his level. Not dramatically. Just enough to trigger doubt. He ignored it. Told himself it was noise. The next day the drop accelerated. What began as a manageable loss turned into a deep drawdown. By the time he exited, the damage wasn't just financial. His confidence was shaken. He became cautious on the next trades, hesitating on good setups. One ignored stop poisoned 10 future decisions. That cost him months. From then on, the rule hardened. The stop was not a suggestion. It was a contract. If price violated the box, the market had spoken. His opinion was irrelevant. He didn't wait for confirmation of the stop. The stop itself was confirmation. This removed internal debate completely. Debate is where fear/greed thrives. Darvas understood something subtle. Stops don't exist to protect money alone. They protect clarity. When a trade is closed, mental bandwidth is freed. Capital can be redeployed. Attention resets. Traders who hold losing positions carry invisible weight. That weight distorts judgment everywhere else. Placement mattered deeply. Stops were placed where the original reason for entry no longer existed. Below the box. Below the structure. If price returned there, the breakout had failed. Staying in the trade would mean trading hope, not evidence. Amateurs place stops where they feel less pain. Professionals place stops where logic ends. Position size was adjusted to make obedience possible. If the stop felt emotionally painful, size was too large. Darvas reduced size until a stop loss felt dull. Boring losses were acceptable. Dramatic losses were unacceptable. This calibration made discipline sustainable. Rules you cannot emotionally follow are useless. Losses slowly lost their sting. They became routine expenses. Just like rent or salaries. Necessary costs of operating a business. This shift neutralized fear. When fear weakens, patience strengthens. Darvas stopped forcing trades to recover losses. He waited for clean boxes again. Waiting felt safe because damage was always limited. This is where the full system quietly aligned. Boxes told him when to wait. Breakouts told him when to act. Pyramiding told him when to expand. Stops told him when to exit. Each component supported the others psychologically. Remove one, and the structure collapses. Darvas didn't think in individual trades anymore. He thought in sequences. A single loss meant nothing. A string of disciplined executions meant everything. This long-term framing prevented emotional spikes. It also made results inevitable over time. Probability needs repetition to work. Stops enabled repetition by preserving capital. Another paradox emerged. By accepting losses quickly, Darvas became more confident, not less. Confidence didn't come from winning streaks. It came from knowing no single trade could hurt him badly. That confidence fed patience. Patience improved execution. Execution improved results. This mindset is uncomfortable for amateurs. They want to be right now. Darvas wanted to be solvent later. That difference compounds dramatically. Intelligence fades under pressure. Structure holds. At this point, the framework is complete. Not as a formula, but as an identity. Amateurs seek excitement. Professionals seek durability. Darvas chose durability. He trusted rules over emotions, price over opinions, and process over outcome. The market never became easier. He simply became harder to break. When structure governs behavior, the trader stops reacting and starts operating. That is how one man outlasted noise, resisted impulse, and quietly outperformed by obeying rules that felt boring, restrictive, and absolutely necessary. What made this operating system powerful was not any single rule, but the way it removed emotional decision-making entirely. Darvas stopped asking how he felt about a trade. Feelings were unreliable data. Instead, he asked whether rules were satisfied. That shift turned trading from an emotional experience into a procedural one. Procedures don't panic. People do. Amateurs wake up asking how much they want to make today. Professionals wake up asking how little they are willing to lose. Darvas framed every decision around risk first. If risk was unclear, the trade didn't exist. This prevented impulse entries disguised as intuition. Intuition without structure is just memory mixed with hope. Confirmation through price was the second pillar that anchored everything. Darvas never tried to anticipate breakouts. Anticipation feeds ego. Confirmation feeds discipline. He waited for price to prove strength, then accepted that proof might fail. That acceptance made failure survivable. Survivable failure is the foundation of longevity. Patience as a position was the hardest rule to internalize. Waiting feels unproductive to the human brain. Darvas redefined productivity. Productivity meant protecting capital until opportunity justified exposure. He understood that most market time is noise. Being active during noise creates losses that compound invisibly. Inactivity, when intentional, compounds just as powerfully. Execution without ego was the final layer. Once a rule was triggered, Darvas acted without emotion. No hesitation. No second guessing. No need to feel smart. Ego shows up when rules are unclear. Clear rules leave no room for identity. The trade was either valid or invalid. Nothing personal. This system solved a deeper problem most traders never articulate: the desire for control. Amateurs try to control outcomes. Professionals control behavior. Darvas accepted that he could not control the market. He could only control position size, stop placement, and obedience. That acceptance reduced stress dramatically. Lower stress improved patience. Improved patience improved results. The method still works because people still overtrade, oversize, and overreact. Speed has increased. Noise has multiplied. Human fear/greed has not evolved. Darvas's framework exploits that gap. It thrives on others' impatience. Every trader-chasing movement creates the ranges professionals exploit. Darvas traded less because he trusted waiting. He earned more because he let probability do the work. He didn't need constant wins. He needed controlled losses and occasional large trends. Those trends emerged naturally when discipline was consistent. This reframes success entirely. Success is not found in brilliant predictions. It's found in boring repetition. Boring entries. Boring exits. Boring stops. Over time, boredom compounds into performance. Excitement compounds into errors. The final lesson is uncomfortable but liberating. You don't need to feel confident to trade well. You need to be prepared. Preparation replaces confidence. Rules replace emotion. Structure replaces hope. When those replacements are complete, trading stops feeling like a test of intelligence and starts feeling like execution of a plan. Darvas didn't outsmart the market by seeing more. He outlasted others by reacting less. He survived long enough for probability to express itself. Survival came first. Profits followed. This is the mindset that closes the loop. Risk first. Confirmation second. Patience always. Ego never. When those priorities are fixed, results stop being mysterious. Cut losses fast. Size small. Wait for confirmation. Own the process.